Okay, folks, welcome back. This is the weekend edition for the ICT Mentorship, September 11th, 2020. It's 19 years since the September 11th event. It's amazing how time flies. I can remember it just like it was yesterday, but never forget. So we're looking at the dollar index as our daily chart, and I'm going to amplify a lesson that you are familiar with, and I touched on this week referring to the crosses. So let's take a look at what we got so far here on September's trading. All right, right away, I want to cover what I mentioned on Wednesday. I said that I'm bullish on dollar. What changes that? And I think if my notes are correct, let me see if I got my notes. About the 4-minute and some change mark of Wednesday's video, I state that a close below Tuesday's trading, that would change my stance on short-term bullishness on dollar. Now, I believe that we're going to trade up into here, above these relative equal highs. I still think that's possible. I really like the market structure that's in play here. Yesterday, we traded down through Tuesday's low. Did we close below it? No. So, like I said, I was giving it the benefit of the doubt, willingness to maybe come down here, clear out some liquidity. I didn't want it to close in this. I wanted to see it stay open, but you can hear I made concession for this type of price action because it had to be on a closing basis. That means it could have wicked through that. Not that there's anything down here on the daily that makes it apparent why it would want to do that. It's just because yesterday was the day for euro and that type of whipsaw price action. Like I said, I wasn't willing to stand in front of it. I kept my my stance neutral on euro dollar, but I co-signed like I always do. Said that the dollar index, I was bullish. I was bullish euro pound. I was basically neutral on euro. I wanted to see if it had the willingness to get down to 117.40, but because we're in a consolidation, or we were in consolidation, still are really, I didn't have a real strong bias one way or the other. So I'll go into the details about how I took the trade yesterday, calling the smart money reversal. I'm sure a lot of you are interested to know how I did that. You can see that video on YouTube where I actually executed and managed it throughout the day. But nonetheless, I also stated that I was still bearish on pound dollar. Okay, so sticking with a narrative, trying not to fancy dance, going back and forth. That's why it's really important understanding institutional order flow and understanding market profiles. We are still in a consolidation for the dollar. Okay. For your notes, and I'll build on this as part of the lesson in this teaching, but you want to have your section open in your journal for explosive price action moves and the effects that the crosses have on that environment. In that section, I want you to write right now, explosive price action moves occur when markets are in consolidation. That means the explosive price action moves are going to happen in the crosses. So the majors won't have a lot of big, significant price action moves generally. There will be large extrapolations in price delivery across the board in foreign crosses, not against the dollar. And I'll talk on that more, but for now, make sure your notes have that in it. So going back to dollar, we're basically chopping wood. Okay, so you have to really know what you're doing and be very nimble. And as a developing student, none of you are that nimble yet. Okay, and it's not a knock against you. I'm not trying to be rude or judgmental or talk down to you. I'm just reminding you as your instructor that you haven't earned your black belt yet. Okay, so you're still a white belt still, and you need to understand that because you are still developing, you should not hold a great deal of expectation on yourself right now. Okay, it's normal for you to not understand how to operate in this environment. It's normal for you to feel unsure about things, okay? Because that's natural for where you are in your development, even charter members, because this is mentorship. You have to understand, like I forecasted when we got into this environment, that we're in an area where we want to dial back our frequency, dial back our expectations, and avoid having hardline biases. Okay, lend my analysis to your analysis. Okay, in other words, lean on my experience and the expertise that I've gleaned almost 30 years. Don't rely on yours in this environment. When it's one-sided and you know I'm talking about high probability, one-directional market profiles, then by all means, go in there and have at it. But when it's like this is the benefit of being under my tutelage. Okay, because this is the environment that beats you up if you don't know what you're doing. If you don't know how to anticipate these types of environments, you're going to get beat up. It's going to chop you up. You're going to think it's one direction over another. And then when the moves occur, especially if you see me like this week, engage in a currency pair and still be able to deliver relatively decent precision, it's a little bit more deflating, okay? Or in other words, it'll make you feel like you're not really progressing, which is not something you should ever feel when you compare myself with you at any stage of your development. I'm always going to have that advantage over in terms of experience. So just because you've been here and you're a charter member, or maybe you're in month 6, okay, or month 5, and you have a whole lot more information in front of you, don't think that allows you or entitles you to know everything that you believe you should know at that time, because you really don't know what you're supposed to know right now. In fact, it's unrealistic for you to believe that you really understand the things that you've gone through. You've only really been introduced to these things. So even as a charter member, you want to cycle back through the lessons, because every time you go through them, oh, but ICT, that's a lot of lessons. That's a lot of videos. Right. Repetition. It sucks to work out. It hurts. You're sore for a couple days after that. But you got to go back into the gym and work out some more. You got to eat right. You got to put in nutrition. What's the nutrition in here? Insight. The lessons. Okay, you got to constantly fortify your understanding, keeping your mind fresh with these things, so that way you know it like the back of your hand. It's not a one-time watch and you know it. So if you don't believe me, go back through it and you'll see. You'll be surprised how much you missed. But anyway, we're looking at the dollar index, and going into next week, I'm still subscribing to the fact that I believe we're going higher to clear this area here and get up into this imbalance. So I want to kind of keep the charts clean. I don't want to put too many annotations. I just want to talk a little bit over them. That way you can go in and annotate your charts the way you feel is appropriate for you. But I'm drawing attention to the levels and what I think is going to happen. But the main thing is just remember, just because we wicked through, that's why I was comfortable with selling short euro yesterday, in addition to what I'll show you when we get into euro discussion. But because we were going down through it and it traded to a specific level, I was staying with the narrative, because this candle has to close before I change my mind about being bullish on dollar. Right? Think. The logic is this candle, this daily candle, has to close below Tuesday's low for me to change my bias. So just because we went down through it and it's still trading on the day, if I see a setup, I'm not going to shy away from it. I'm going to engage it. And the economic calendar was heavily slanted for a euro event, and there was an absence of any pound information. And as I discussed, that means if there's an absence of something on the economic calendar, that's just as important many times as if there was a major impact news event. If there's a disparity between a heavy news event like we had for euro on Thursday versus a closely correlated pair like cable, and it doesn't have any news, cable's going to be allowed to trade freely. It could do a whole lot more freedom of expression, if you will, in its delivery of price. Whereas Eurodollar is being manipulated heavily, and it still is heavily manipulated. But it's also being seen in the dollar as well, because they're very close, dollar and euro, because the index is heavily weighted in euro. So we can see we forecasted this type of price action, but try not to believe when you see a setup in the formation of maybe a New York setup or a London setup. Try not to fall in love with the idea or anticipate much larger magnitude type moves when we're in this environment, because really, if you're doing that, what are we actually saying if we think that or subscribe to that school of thought? We're trying to predict a breakout, when in fact all I'm trying to do is work within the range here, and this is the dealing range high. So what's going to be residing above that? Buy side liquidity. So what am I using as an array coupling that idea? We have an imbalance over here. So we have a sell side imbalance, buy side inefficiency in the form of a fair value gap with this low. This candle's high right in here, which resides above these relative equal highs. This high being lower than this one, so we have a very clear signature. It does not mean that I'm going to be right that it's going to trade up there. It just means that because I have to tell you what I think is going to happen in the marketplace every time we sit down, I'm telling you that I'm still subscribing to this view. And I'm giving you the parameters and many of the algorithmic theories that align with that thinking. In other words, I gave you this idea, it needs to close below that. Why does it need to close below that? Why can't it just be a break below that low and it gives you your definitive answer? Because of this idea over here, and we're in a consolidation, and we've already ran out sell side liquidity here with this run. We ran out the sell side liquidity here with this run, and we've broken this short-term high. So this short-term high rate, while I'm not becoming overzealous about the idea of it potentially going higher, and it could explode higher. I could be wrong in that effect, where while I'm short-term bullish and I'm only looking for this, it could pop up into the 95s and completely go way beyond what I expect. That's fine. But that's what I'm trying to cultivate in your understanding, is you need to be able to frame reasonable expectations and try not to get in here like a gambler. Okay, you're just rolling the dice and seeing what happens. Okay, or the slot machine mentality, where you just go in there and think, I think it's going to do this, so therefore let's go in here and bet the farm on it. You don't want to do that. I did that a lot in the 90s, and I lost in blue accounts doing that. So if it would have closed below this candle's low, then I would be feeling more comfortable with the idea that this was a run above the buy side liquidity, and then we could start to go down. Okay, so in other words, it would be like a turtle soup type scenario, false breakout. But because this candle here on Tuesday, Wednesday was the last time we talked together in mentorship, and Thursday's trading here and Friday's trading here, it could have created an inside day within this candle's high and low. In other words, the candle for Thursday would have been a high lower than Wednesday's high and a low higher than Wednesday's low. So that's an inside day. And then Friday could have broke down and closed below that. And then I would be talking to you right now with that idea, thinking, okay, then I wouldn't be bullish. I would be telling you, okay, I'm bearish, and I'm looking for it to come down in here initially and then see if we want to break down below that. But because I gave that filter of it needing to close below this when we traded down through that Thursday, while the markets are trading, and if I see something that lines up, as I'll show you again when we get to fiber, I'm going to take the trade. I'm going to stay with the narrative that I given to you. So again, that's one of those things where if you try to arm wrestle me here with that kind of stuff, you're going to frustrate yourself. And we've had people in the past email me constantly, months on end. I don't know what I'm doing wrong. This stuff doesn't work for me. What are you doing? And come to find out, they're fading everything I'm explaining in the reviews. So, go figure. Don't do that. Try to operate with the perception. I'm laying it right in front of you, but you have to use these things and practice with them and study it with that mindset, because the faster you start to think like I'm trying to have you look at the price action, the way I'm not here to waste my time. I'm trying for you to adopt the same mindset that I have about these candlesticks. within the context of the profile that the market is likely to trade within. So if you resist that and you're thinking, well, I'm going to try to look at the charts and only work with my perception of it, at some point, there are times where I tell you to do that. But when we're doing if you're going to watch these reviews, then it's beneficial for you to subscribe to the ideas I'm pointing your attention to. Otherwise, if you want to just see how well you do after the fact, then don't watch the videos. Okay, because to watch the videos and then fade that idea, you're not really building anything in terms of understanding. Okay, it becomes a contest, and that type of thing you'll lose. So just don't do those types of things. So anyway, long story short, I'm still bullish dollar. I'm looking for it to trade above here and trade into this area here. That's all I'm looking for initially going into the next week. It might not do it, but that's what I'm looking for. So I'm co-signed on still bullish dollar. And it would need to trade now. Listen to this. This is carefully being said, not just throwing it out there. If it trades below Thursday's low, even if it just trades below Thursday's low, I'm going to look at that run here as a false breakout, and we got to consider maybe trading back into here and rebalance to some degree, if not trade out below this low. All right. Ended up trading to 92.70, and we have a small sell side imbalance, buy side inefficiency in here with a breaker. So we have a low here at 93.45 with a high on this candle trading it at 93.45. Perfect delivery to the breaker. I've outlined two different things in here because I wasn't sure going into the Thursday event. I said we could potentially trade down into here or trade up into here and then trade lower. It went here first, so when it traded up to this level here, it isn't going to likely go back down to this level because, again, the filter I gave you on Thursday was it needs to close below Tuesday's low. It didn't close below Tuesday's low. It traded down. Small little imbalance here, fair value gap. Bullish order block, the big candle, not this little one. Trades into that and then consolidates into the close on Friday or today. I like that the market is showing a willingness to reject this down here, and it found a discount array where it respected that, and we didn't come off aggressively going into the close. We have a signature with the lower high versus this one, and this high is lower than this one. So think about what I'm telling you. Lower lows, lower highs, okay? That's retail thought. So I'm telling you lower high, lower high, lower high, and I'm thinking we're going to probably make an attempt to get into that 93.70 level above here, and how we trade there, if at all, we'll have to, obviously consider that when it does it. It may not do it. I may be wrong, but we'll see what happens. And then finally on the 15-minute time frame, scrunch this up a little bit more. All right, I drew your attention to this order block and fair value gap there. I said we could potentially trade down to that, and we overshot that because of the Euro news event that came out on Thursday. So the market traded down aggressively and then gave it all back up into this fair value gap breaker as I outlined. Beautiful delivery. Back into the order block here. Traded into that. Cleared all this really clean highs out. And we still have, again, I like the market structure we have here. I don't see it going up here, 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 and then going down. It don't make any sense to do that. But we're not in a year of a lot of things not making sense. But I still feel confident that we're going to go higher on the dollar. And I've already given you the filters that would change that idea. All right, so here's the euro dollar. Now, I want to start with the lower time frame on this one and work my way out. All right, so this level in here, we're going to look at that when we zoom out. But this is the market maker sell model. And the original consolidation here, we left it, came back down into it, accumulation, reaccumulation after it touches the original consolidation, expansion, reaccumulation, smart money reversal. Right in here is where I'm going short. And again, I'll explain to you in detail why I did this. But for now, just take a look at what happens. The market breaks down, trades back up into this level here, which will be clear when we go to a higher time frame. Then it breaks down again. You know this is institutional order flow, entry drill. Sells off again, attacks the sell side liquidity here, and ultimately over here. Okay, right in here. And then we have a really quick run back up into this old area order flow. And I did not get an opportunity. Had I been in front of the charts, I would have sold short right in here. Just as you saw me do it here, I would have done it right there and aimed for this area as well. But I wasn't available. But I got on the charts a little late today, and you saw me do what I did today. And then Bailey and Bella, they got into their treats. And we get these, I guess they're really good. They love them. They're like a peanut butter in a vegetable wrap. It looks like a fruit roll up, if you ever seen what they are in the United States. But they're like real, they smell like really good peanut butter. So we bought these things, and I left the bag open. And they got into the pantry and literally ate the whole thing up. So my wife has the kids, and I hear them, they're whining by the door. And I'm obviously, like, I'm looking at the charts, I'm watching, I'm monitoring it. I'm like, they got to go to the bathroom. And if I don't go and let them out, they're going to do an accident in my house, and I'll lose my mind. So I can't just go ask my wife, hey, can you let them out, because she's homeschooling our 2 younger boys. So I said, okay, I got time. I'll get up. I'll go let them out. Well, I get them on their leash. I take them outside. And, of course, Bailey's out there. She doesn't want to do her business. And Bella's ready to come back in the house. So I have to make sure that they finish their trip. And when we come back in the house, I've already missed the opportunity to close out that half the position. Or actually, it wasn't half. It was more than half the position. I was trying to close it. And then the rest of the time, it would have been very little exposure. And you've seen the trade. But as you can see, I'm not exempt from those types of things. If the real world steps in and creates distractions and such, just because I'm ICT does not mean that it won't happen the same way like it does for everyone else. So I am a family man. I am a pet parent. I am someone that has people around them constantly, children at home, homeschooling, and many distractions. So if you're not paying attention, the market's not going to wait around for you, and it's going to go. And if you ain't there when it happens, too bad, you missed out. So I tried to make the best of it today, but it is what it is, and you end up seeing it get stopped out. So about 14 pips or so is better than nothing, but nonetheless, tight range for euro-dollar trading. But I wanted to operate with the idea of not going long euro-dollar. Okay, while we had this price run here, okay, I was watching it run up here, and I wanted to see if we can get up into this level. If it did, I felt really confident going short, because I'll show you in a moment. I know I keep saying that, like, oh, he's going to keep saying that, but he's going to forget to say it. Trust me, it's the heart of the lesson. So, but I didn't want to buy it. Okay, so the reason why I didn't want to buy it was euro pound. Okay, I'm going to come back to euro dollar, but let's jump over to euro pound because it's salient to what my discussion is here. So if you look at euro pound, okay, here is Thursday's trading. I said in the video on Wednesday that I'm still bullish euro pound. That looks bullish to me. So it really rallied hard, and it took out the daily high. Let's go out to the daily. So relative equal highs. This high is lower than this one. So it ran out on Thursday and traded up to here. So it looks as if they really probably want to take it up to here and clear that out, if not the rejection block. So we're going to talk a little bit about this run up in the cross on euro pound and how that same idea used in other currencies can help you find the explosive price action moves. The YouTube video I talked about this cross-currency relationship and how you can find explosive price action moves. When you have markets in consolidation, it means that you need to be looking at the crosses, the foreign crosses, not the majors with the dollar. So if we know that this pair is bullish, as I clearly outlined and told you, we would expect what scenario? Again, for this currency pair to go up, euro stays in consolidation and pound drops, or cable is held in consolidation. In other words, British pound versus US dollar is held in consolidation, is not allowed to trade up or down, what stays in a trading range, while euro rallies. So we have been seeing euro dollar in consolidation and cable going lower. So that's the narrative. That's how they've been booking this weekly profiles or the weekly range. So this entire week, euro has not gone up except for the run-up we had yesterday on the 10th. So if we go back to euro, we're in this tight consolidation. It hasn't really moved out of that, has it? No. But if we zoom in, this spike up, okay, this run up in here, it's trading up into this last up close candle, bearish order block, okay? And watch what happens when we drop down into, if we drop into the hourly chart, you can see the fair value gap. First punch into it was consequent encroachment, left the remaining portion with the bearish order block. That's those levels. So as it's running up, like I said, ahead of the ECB rate announcement and such on Thursday for Bank of England, I was wanting to see if it was willing to trade down to that 117.40, but I wasn't confident to take a trade into it because we were in consolidation and it could go either way. So I'm not willing to take this long trade. Why? Because that euro pound cross is in control. They're using pound dollar running lower. As I told you on Wednesday, I'm still bearish on pound dollar. I was bullish euro pound, and I was bullish dollar. So the mechanics that were outlined for you was, is it high probability to buy euro dollar? No. Well, what about this price action move here, Michael? If it's not high probability, what about this move? That means it's a move I'm not taking. But if it forms, great, because this is manipulation. It's only reaching up to rebalance to this price point over here. So as it's trading up into that and closing in that fair value gap, take this box off. As it slams up into there, that smart money reversal, I'm selling short right in there. So that's what I'm doing in that video on YouTube. So the video I posted on the 10th, as it's running up into that, that's what I'm trading. I'm not trying to buy it. Now, for those of you that are charter members, you know that the price action model number 6 and price action model number 7, I talk about how you can use that price action model and working with the sell side delivery. Okay, so I'm using that idea here. I'm not interested in taking this one here. I know it's likely to unfold to this price point here. So I'm going to sit on my hands and wait. And when it does, I got no problem going in and engaging because I know what they're doing. Euro pound is bullish. This is unnecessary price action. You don't need to see this happening. They're running it higher for the sake of knocking out traders. Now, everyone can look at this and armchair quarterback and say, well, look at this obvious bull flag. And, well, it went further than the bull flag. It went right to what I'm outlining here. And you know these things. I'm teaching you this. So you watched me engage it live before it happened. I outlined it. I told you what it was likely to do. And it went right down here and did it. So this price action right in here, this is the bearish order block. This is the open on that. So it's the opening price here at 118.87 and 7 pipettes, and the high on this one comes in at 118.87 and pip bet. So it's only off by 1 pip bet. So again, open 87.7, high 87.6. Okay, so it's only off by 1 pip bet. And I was telling everyone by way of that text annotation in my chart that I was willing to allow for it to trade up into that 5-minute bearish breaker. And it didn't need to do that, but this is the level it was very responsive to here. All right, so and then it starts to break down and does all the other business that you know about. Dropping back down into the 15-minute time frame, you can see all of this now makes a whole lot more sense. Some of you will say, okay, I think that this price run in here is justified, and this would have been your target to get out of your long. I'm not interested in doing that. Not to disparage you from taking that trade or using that for the price action models that you learn as a charter member. I'm just saying that I felt more comfortable because of all the other things I've outlined for this week, which is Euro pound being bullish, and what's the catalyst for that to be true? Cables dropping, and euro dollar is held in consolidation. So I don't want to buy euro dollar, but if euro dollar starts to run higher, that does not fit the model. Okay, this is all manipulation. It should not be rallying. It doesn't need the rally because cable's dropping, which is allowing the euro pound to rally. Okay, so remember, the algorithmic theory is euro pound's going higher. So which one is likely to be held in consolidation? We determined that it was euro dollar, and cable would be allowed to be freely trading lower, no manipulation. If euro dollar rallies, that is a Judas. You just have to know where it's likely to reach to for a premium level. So my premium PD array was this fair value gap up here. So as it runs up into that, no problem. On a 5-minute chart, it looks like a mystery, but it's not so much of a mystery now because you can see clearly what I'm doing. It seems like wizardry. It seems like, man, there's no way I would have been able to pull that out. That's only because you haven't been studying long enough. That's all. That's all it is, folks. The longer you spend time with me here, the more this stuff's going to be ingrained in your understanding, and you'll see them. Trust me, you'll see them. That's what mentorship does. You're not expected to watch the videos and understand how to find them all. It's being trained and drilled every single week and month after month after month. And over time, you will know what you're supposed to be looking for. And I'll point out things. But it's important for you to know the mechanics that were used. Everything I outlined, everything was there. This is what I showed as an example. It's better than me coming back on Friday and saying, okay, look at what it did here, blah, blah, blah. You watched me. You watched me do it. Okay? There's been people in the past that have said, you know, I need you to start trading, or I don't believe you. You're a fraud. I told them to leave. I'm not going to jump through hoops for you. You're here to be trained. I'm not here to perform for you. So I do this once in a while just to prove, number one, the effectiveness of the things that you're learning, how to implement the things I talk about. If I say euro pound's bullish and cable is bearish and dollar is bullish, and I'm telling you that the crosses are where the explosive price action moves are going to occur, you need to pay attention to those things. And then you get these types of lessons, which are phenomenal. I wish I would have learned this from someone, okay, that could sit down and show it to me. I had to have it revealed to me through pain and suffering. So just know that it takes a lot to get this, okay? And it was only by the grace of God that I was able to see these things, because they're not in books. I can't take you somewhere and say, look at this, or this person knows this. They don't. So it's not going to be easy for you. It's going to take you a lot of time to get this, but you're working towards it, and you're on the same path that I'm on. We're going towards excellence every single week, every single month, every single year. That's what you're part of, that community that has that mindset. You don't need signals. You just need the processes, okay, and the logic that goes behind all of it. So anyway, price runs back up into high to low, back to a premium, And like I said, I would have shorted there and attacked this level here, but I wasn't able to do it, so I worked in here, and it just got really choppy and didn't do much towards the close of the day. But that's the business there. It might stay consolidated a little bit more, but eventually I think euro dollar is going to give up the ghost. It may require euro pound reaching the rejection block on its daily chart, or altogether blowing out the high. So, that's kind of like the pair I'm watching to decipher what euro is going to do. But I don't want to buy euro. If it gives me an opportunity to sell short again, I'm going to sell short. Okay, I'm staying with that narrative because I know that there's potentially a tiger I'm going to get by the tail. Okay, and that means I'm going to catch a runner on euro dollar, and it's going to move nicely for me. In other words, there's such a degree of separation between what euro dollar is doing versus cable, okay, pound dollar. They got to get back in sync with one another eventually. And right now, there's a wide disparity between the two. So the longer it takes, the bigger the move's going to be in euro dollar. So just relax. It'll eventually form. And when it does, it's going to be salad days for selling short on euro dollar. But for now, you have to be really nimble. So with that said, let's go on over to cable. All right, so here's the British pound versus US dollar. This is our daily chart. And we came down, we cleared this low here, as I mentioned earlier in the week. And we traded into this fair value gap here. And I didn't really draw any attention to anything down here for a downside objective. But, we do have an old high here, so that's a likely scenario to trade down to it. So just for the sake of discussion, we'll have that there. Not that it's a whole lot of secret sauce there, but I told you on Wednesday we're looking for lower prices still on cable. I was bearish on cable, so there you go. High being taken out here on the daily chart. What is this? Institutional order flow entry drill. So we have an imbalance here, fair value gap with an old high. So you'll have to just give me the latitude here to trade in here into that as an objective. The idea of this trading lower, again, was given to you on Wednesday, but look at the hourly chart. I said the liquidity pool here, I said that we could potentially trade up into that because of a possible scenario, but it only traded right back up into these last two up close candles and the fair value gap right there. So returns back to the order blocks there after taking out relative equal highs. High to the right is lower, punches up, very shallow run. Very, very shallow run. And then breaks down, comes right back up to the bearish order block, which is these three candles here. Extend that out in time. Boom, hits that. Breaks down low resistance liquidity run into the old high on the daily chart. And then consolidation. I don't think we're done going lower on cable. I think that we could potentially whip above here and run that out. Or if it just starts off on Sunday heavily, opens lower and trades back up, that's actually bearish too. So this could be another leg here added to this down. So we could see maybe even 126s, high 126s on cable. But that's just a rough idea for right now. We'll have to see what we do on Sunday's opening. Again, we're in the weekend, so I try not to do all the precision stuff on Fridays because I don't have Sunday's opening, and I need Sunday's opening to arrive at other things, to give me the analysis. But for right now, sticking with the narrative that I'm still bullish on dollar, still bearish on cable. Euro pound still could go higher, and euro is going to be held in consolidation, and I don't mind taking shorts if it offers it to me, but I don't want to buy euro dollar. Finally, 15-minute chart. You can see not too much going on since yesterday afternoon in British pound, but just a beautiful, beautiful run. Institutional order flow entry drill here, and bam, down. Nice movement here off this run up. Rejection, trades up, slams. Just for the sake of curiosity, swing high, lower high, lower high, high in the middle. $62, got it. Premium, yes. Breaks down. Just fell short of 1.5 standard deviation between this and this. So it still has a little bit more downside, I think. Now, here is the good stuff. All right. So we've gone through this week with lectures both in YouTube and on mentorship about the crosses, the effects of euro pound and such. If we look at the relationships of how the majors coupled with the dollar, dollars being held in consolidation, euros in consolidation, cable is weak. So we went through the process of determining which pair in euro pound makes that pair move higher. We've canceled out any bullishness on euro dollar. We went to euros in consolidation, cables dropping. So right away, from a relative strength analysis point of view, that says what about cable? It's extremely bullish, moderately bearish, extremely bearish. Extremely bearish it is. So what happens when we look at currencies that are closely correlated like Aussie and New Zealand? Now, we don't talk too much about that, but I want you to understand just because I don't talk about it doesn't mean that the concepts don't work there either. So we're going to go into a daily chart of Aussie versus New Zealand dollar. All right, so here we go. So we have seen bullishness just like on the dollar with this cross. But this cross starts with what? Australian dollar versus the New Zealand dollar. So if this pair is going up, that means what in relationship to these two currencies? It means that Australian dollar is stronger than that of the New Zealand dollar. Okay, so if we want to find a weaker currency between the two, which do? We use the New Zealand. If we want to look for the stronger of the two, we use the Australian. Now, think about what I've just outlined there. We're looking at two crosses, euro pound. We've already determined all this week before it happened that cable was the weaker or the sick sister between the two. Euro would be the relative strength leader. It doesn't mean it's going up. It just means it's resisting price declines. So in a relative strength analysis perspective, euro stronger, pound is weaker. Now, if we're looking at the Australian versus the New Zealand dollar, the same thing is said here, like the Australian dollar. It's holding the same perspective that I hold towards euro dollar. It's the relative strength leader versus the New Zealand dollar. Because if this cross is going higher, that means that on a relative strength basis, New Zealand's weaker and Australian is stronger. So now watch what happens. You have, just like in fractions, you went to school and learned about fractions. We're going to group one part of this fraction, Australian and New Zealand, and we're going to couple it with the denominator of euro pound. The denominator of euro pound is cable, and it's the weaker of euro pound. The stronger of Aussie New Zealand is Aussie. So what pair do we have in Forex that we can group together with the Australian dollar and the pound? Pound Aussie. It's going to get fun now. GBP Aussie Forex.com. Ooh, look at that. So now we're going to drop into an hourly chart on this pair. When there's a sell-off expected in cable, and all things being equal, as I've said for this entire week, the crosses are going to have the big explosive price action moves. The majors coupled with the dollar are going to be stunted. Okay, they're going to be choked or strangled. And if you're just watching those pairs, it just feels like Forex is dead and nothing's really happening. But your attention has to be diverted from the dollar crosses to the foreign crosses and start looking for the relative strength leaders and the relative strength laggards, and then matching them together to get the big explosive price action moves. Now, cable, it went down a lot. Nobody's arguing that, okay? But it helps you find and ferret out, at least what I'm teaching here, is where are these big explosive several hundred pip moves. This is how you find them. We went through the process of looking at the euro and pound for euro pound cross and determined the weaker sister is cable. If you find another cross that's closely correlated, like pound and euro is with euro pound, Australian dollar versus the New Zealand dollar, the same thing, you can do that there. So you can find the weaker of the two and the stronger of the two. So if we found cable as a weak currency, if you can couple that with a very, very strong currency, you're going to get an explosive price action move. Why? Because it's this same day here on the 10th where pound Australian is dropping, Australian dollar's going up on the 10th, where the cable market, pound versus dollar, was going down. So you're having this diametrically opposed price action where a strong currency is going up, doesn't need to go up a lot, just it's going up, versus a currency that's going down and it's already weak, that of cable. So you're looking at a relative strength leader on the upside, Australian dollar, versus a relative strength leader on the downside, cable. Finding a currency pair in the Forex universe, that's GBP, AUD. And then you can get these types of price action moves here, where it runs from a high of 79.25 to a low of 74.94. That's a big chunk of pips. It's a lot of pips. It's ferreted out by what I'm showing you here. Now, this type of stuff, you don't learn this like on baby pips. You don't learn this on, well, I'm not going to sit here and knock down everybody else. It's just, nobody talks about it, okay? How you find them and when to anticipate them, that's what you learn here. The interbank traders trade like this, okay? I don't get the tax treatment, even though these moves are beautiful. I don't get the same tax treatment that I do if I trade with a dollar cross. And once you start trading profitably and you use an accountant that knows everything they can do legally, and you get trader status, you can get a lot of things that otherwise wouldn't be available to someone without trader status. But there are some limitations with it. And if you start moving volume and size in your trades, you're not going to get treated well. Even though you can make a lot of money doing this, I can make a lot of money trading the majors with the dollar. Remember, you're listening to a guy that can find these moves, but still I look for 50 to 75 pips a week because I want a life. I'm not chasing money anymore. So you as a developing student, you may not have those viewpoints and say, I don't care. I want these treasure hunts like that. Well, now you know how to find them. And now, every time we go into consolidation, okay, in the future, write this in your little note section for cross currencies and relative strength analysis. Explosive price action moves occur when the majors or the dollar index goes into consolidation. There's going to be big moves in the crosses, but you have to go through the process of finding the stronger versus the weaker in like Euro Pound, and now you saw tonight with Australian New Zealand. And it's not limited to that. You can literally go through the commodity markets, the currency futures, and look at the price action on the Japanese yen. I hate that pair, or hate that currency. Nothing against the Japanese folks. I love the culture. I've been training in martial arts, and I literally wear a kimono in my home. It sounds odd, but my wife looks at me all the time, and she's like, why do you wear that stuff? Because it's comfortable. I love it, and it is what it is. But I don't like your currency. It's burned me before, so I don't give it any opportunity to take anything back from me. Just like the Swiss franc. I don't do anything with the Swiss franc because it's burned me. You're probably thinking, well, it's just, you shouldn't feel that way if you're ICT. Listen, I know me. Because if I go in and I lose money, I'm going to be mad. And I'm going to go right back to doing things I know I shouldn't do. So to avoid that, because I am human, I don't touch those two currencies. Okay? But you can go through all the futures contracts that trade currencies and literally look at the price action of those markets. And you can find the relative strength leader individually looking at those, or you can do it the same way I just showed you tonight, looking at the crosses, the Euro Pound, the Aussie, New Zealand, and then go through all the other currencies, okay, and find the stronger of all of them and the weaker, and then pair them up. Now, there's a lesson in the mentorship if you haven't gotten that far, and forgive me, I just don't know exactly where it's at because there's so much stuff, and I can't recall off the top of my head where I have it, but I literally go through the process of showing you how to do this. And step by step, kind of like what I'd shown you here, where I did it loosely. I go through the process of stepping through each individual one, and I ferret out where, and I think I'm not mistaken, I think I did it in the commentaries. Don't hold me to that. Don't take my word on that, but my memory says that I think I did it in a commentary. But I show you how to find relative strength analysis, leadership, and laggards, so you can find explosive price action moves. And this is another week where you see it. Now, you're probably saying, well, why didn't you tell me about this, ICT? Well, I'm not running a signal service, am I? No, I'm teaching you how to find this stuff. And everything I said this week leads to that. Euro pound bullish, dollar bullish, cable weak. What did we get? We got those things. Euro dollar rallied. That's a Judas. I want to sell short that one. I don't want to buy it, but it happened on a day where it had news. So they used the news to inflate the euro dollar into a level that's a premium array that we would look to go short at. If you were long, you'd be looking to get out there. Where I went short at the smart money reversal in euro dollar on the 10th, it's a matter of perspective. Some of you would have said, yeah, I feel comfortable taking the long, but I don't know if I would have sold short. And now that you see what I'm showing you here, all of you are nodding your head saying, yeah, if I could seen that, I would have taken that short. And you'll get to that point. But what I was saying about this here, and then we'll close this video, on the 10th, with the pound dropping, and you can see it coupled against the strong Australian dollar, it really fell out of bed on this cross. But if you look at the 10th on Aussie dollar actually went up. Okay, so look at this price action here, and you're going to see the opposite on Aussie dollar. So the disparity between these two crosses, that's how you find the leadership. Now, what if you were to look at New Zealand dollar? Similar. It's in consolidation while cable is dropping. So it's a relative strength leader versus a laggard in cable. So it's going to be more likely that pound New Zealand will drop harder, but pound Aussie is the better short. Pound New Zealand. And boom, big decline. Okay, so explosive price action moves, that was the theme of this week. Even though we won't find them in the majors, we find them in the crosses. So in your notes, before I close this video, you should have the following. Explosive price action moves occur in the crosses, foreign crosses, not dollar crosses, when the markets are in consolidation with the dollar, and it could be euro or cable. If one of the two is matching up with a consolidation with the dollar index, you don't put so much attention on dollar crosses. You leave that and go through the protocols I've outlined here. You go through all of the stronger and laggard analysis, looking for relative strength analysis, leaders and laggards, and then couple them together with the directional bias of the weaker or the stronger. In this case, we clearly found that cable was the weaker of all the currencies. So if that's true, that means you're going to be looking for a strong currency to pair it up with the pound, and then it should drop down. Just for sake of discussion, let's look at dollar yen. I don't know what this has done this week, so I don't know. All right, so it's in static. Okay, so pound yen should have declined relatively. Well, it should have dove down pretty good. So if we look at GBP, JPY, let's see what that did. Yep, had a nice decline. And let's look at the Swiss franc. All right, so on the 10th, we had a lot of weakness in the dollar versus the Swiss franc. So that coupled with then goes in consolidation. I guess it's what, pound Swissy? Pound Swissy should have had a nice decline as well. And there you go. So 1850 to 1600. Did it get that low? Yep, it went down to 1599 and 5 pipettes. So 250 pips, overnight from Thursday into Friday. So not bad. Now, I know some of you, especially the new folks right now that aren't used to how I operate, you're probably burning right now. Ugh. If you knew this, why didn't you tell us? Because I'm not operating a signal service. And there's a lot of you in here that are doing things you're not supposed to do. And you know what I mean. So I'm not going to provide a lot of mojo for you to look good doing your things that you're not supposed to be doing. And you know what I'm talking about. So other people are thinking right now, oh, this is rude. You're holding back. This is not as described. No, I'm telling you what's going to happen before it happens. But now I'm teaching you how to find this stuff. So in your notes, you now have clear directions. If we're in consolidation on a dollar, what's that mean? If I say, okay, we're in a period of uncertainty, low probability, boom, that's green light. What's that mean? Abandon dollar crosses. If you're looking for big moves, stop looking at the dollar crosses. Start looking at all the foreign crosses, the currencies, and do what I'm showing you here tonight. If you start breaking them down, you aren't going to find them right away, but over time you'll start seeing the patterns that I'm teaching you occur in these pairs, and they'll have big moves, but you're not going to, I guess, appreciate it until you see it going back in hindsight also. So if we have been taking copious notes and are very detailed, when I'm saying that I'm thinking that we're in consolidation or we're in low probability, you should have been including that in your notations in your own study journal, and then find that in your study journal where I've indicated that we're in a low probability condition in the marketplace, and then go through this process as a homework assignment. I don't want to know. I know I can look at my charts myself, but don't supply that to me in an email saying this is what I found, because I'm so far behind in emails I can't keep up. But for your own edification, studying it and looking at it in hindsight with what I've shown you here, you are going to get really excited, because you're going to see that it's not just plucked out of hindsight saying, look how smart I am. These are the same rules that I've been talking about in the mentorship. These are the things, okay, and I taught you tonight the missing piece. Because I didn't tell you when the markets are in consolidation across the dollar crosses, that's the trigger that you go into this. Ooh, see? You made it to September. The people that did not pay, they did not get that. That's not that big of a deal. It is. Oh, it really is. It's a big, big deal. So things like this occur also with the commodity market, where we can look at relative strength leaders in the commodities, and I focused on soybeans, if you recall. I just don't have the time to go through all of those 20 videos. It sounds terrible and sounds lazy of me, but I know I discussed the soybean market in the Optimal Trade Entry Pattern Recognition series on the YouTube channel, and I used one of the examples I know I talked about sugar, and I know I talked about soybeans. I just can't recall which one it was, but the soybean market, if we take a look at that, and I promise we're done. No, I'm going to talk about gold before I close. But let me get to soybeans real quick. And there we are. November. Isn't that cool looking? Looks just like a Forex pair. If we go out to the daily chart, I sent this on the community tab this morning. I think it was this morning. I'm losing track. I've been up for 37 hours, almost 35. I've been up for 35 hours, so the days are running together. But if I take this off for a second, you all can see this price structure. Okay, original consolidation, leaves the consolidation, comes back to it, distribution, redistribution, smart money reversal, low risk buy. All of this is being held in the same area that starts the low risk buy. So this is held in consolidation, but it's still part of this move here. Then we rally out, comes back in, reaccumulation, runs up, gap. Not here, that is a gap, but over here. This is the one I was teaching you about. So this gap, if it goes back above it and comes back in, finds support, reaccumulate there, runs. Look how it drives hard through these relative equal highs. See that? That's showing you that it wants to not just go above here, it's targeting over here. And I told you that. Bang. We slam through it, add the indentations back. Hello. These lines have been there. I haven't done anything except for put hello today. So a perfect market maker buy model on the soybean market. And this actually is, if you were buying down here or in here or in here, that is a 5,000 plus move, $5,000 or more, depending if you go back here. But if you buy in here and get out up in here, that's $5,000 per contract. If you had 20 of them or 20 call options in here, writing that out, that's over $100,000. Man, forget Forex. I want to trade soybeans. That's how I felt when I first started learning how to trade back in 92. I was sitting down reading that book from Ken Roberts, and I was like, I'm going to be a soybean trader. And why did I say that? Because one of the guys that were on his little cassette tape back then, that's what he sent out, a little cassette tape, Real Money, Real People. And the guy's name was Dan. And he was like, yeah, my first year trading, I pyramided soybeans and I made $100,000. And everybody's like, wow. And I'm thinking, man, $100,000, that's insane. And he said, yep. And the guy that was interviewing him, he says, yeah, and this year I've done better than that. Oh, yeah, better than that. He goes, yeah, what do you mean? He goes, I've more than doubled that. What? Yeah, $286,000. If my memory's correct, I think he said like $285,000 or $286,000. Trading one market, just doing one thing, waiting for a big explosive price action move. Now, you learn this stuff in the mentorship. I did not learn this from Ken Roberts. In fact, I got to see if it's something that I could even do, because even though it's out of print, I might share one page or two out of that original manuscript, but I don't want to just copy the entire book. But I want to kind of like point to some things that are so glaringly obvious how I hurt myself trying to use what he was talking about in that book. And he peddled it as a course, but it was just a book talking about commodities and things that really wasn't a process whatsoever. But in my mentorship here, this right here, that is a mega move. It's not over. I think it's going to continue, especially if we have all these other things occurring like I think they're going to do. But we won't know that until November. But I think November we're going off the rails. And depending on how bad that is, that sets the tone for food wars in 2021. We're going to have problems getting food. And it's going to be crops and things like that. And soybeans are in everything. You know, soybean meal is in everything. A lot of processed foods and such. Wheat is in a lot of things as well. Corn's in a lot of things. So these markets are potentially setting up all this business in here. If this is trading in like $12 a bushel next year or $15 a bushel, it's going to feel really cool that I showed you all this stuff at the beginning of the move. And I'm not worried about this move here. I want to see if this market goes to a premium. Now, for some of you that are new, that haven't gotten to the commodity section, when I say a premium in commodities, what that means is like this contract delivery month is November. And Some of you probably are thinking, why am I listening about soybeans? I'm here to learn about Forex. No, you're learning how to make millions. You're learning how to be wealthy, how to master money. And this is opportunity. And these markets are real markets. Fiat currency is just an illusion. You can't eat a currency, but you eat these things. This is the world's grocery store. Regardless if Forex ever craps out, if crypto ever craps out, or stock markets crash and they stay in a doldrums for a long time, this market, the commodity market, will always produce millionaire making opportunities every single year. And how does it start? It starts with understanding what the dollar's doing, because if you don't understand what the dollar's doing, you're not going to find these big moves in the commodity markets. So we have been bearish on dollar. So that bearishness on the dollar allows the price to inflate in commodity. I was going to say currencies in the agricultural markets and other commodities like oil, the metals, which I told you gold was going to go up. I told you silver was going to go up. I told you we'd go to 2,000 in gold. We went to 2,000 in gold. I told you that we would see a big bull market in commodities. Coffee went up a lot. The grains have gone up, but leadership has been in what? Soybeans. Study the difference between the wheat market, the corn market, and the soybean market. Soybeans have been the relative strength leader, and that's why it's been going up. If you look at the differential between soybeans and the dollar, it'll be clearly obvious what's been going on. Okay, here's the high in the dollar. Dollar's been going where? Down. Here's a lower low in soybeans, running out that low here, and then bullish. I wasn't just pulling your attention to it in that 20-day example of finding optimal trade entries just for the sake of, okay, that works. I'm pointing to something I can talk about because you all know about it. They can't take it off of YouTube. They can't deny they ever saw it, and you didn't miss it, obviously, because I've talked about it even in mentorship. But all of this movement here is a direct, diametrically opposed move to the dollar going lower. When the dollar is going higher, commodity prices are suppressed, and it makes them go lower. It doesn't happen right away, just like going up, it doesn't happen right away. But when this occurs, this relationship here, you are looking at millionaire making conditions. Now, when it has this environment where the dollar's going lower and a commodity is already bullish, we've already priced in, now they're really interested in picking up soybeans. Okay? So if the November contract price, which is right now trading at, I got to take this off now so I can get the price back on here. So the close on soybeans as of today, Friday, the September 11th, 2020, the close is $9.96 a bushel. Okay, so if we look at January 2021, which is the next contract month, okay, just remember $9.96. Okay, if we look at January 2021, its closing price is $9.99. Okay, so it's a little bit more. That's a normal carrying charge market. So there is no premium. And that's what I was saying earlier. Don't be confused when I say a premium market in commodities, because these markets have contract months that expire. So in November, that delivery contract that I was showing you before I changed to this chart, even though it looks the same, it's not. The prices are different. And the further you go out in time, the normal carrying charge market for commodities, it's going to be a higher price in the future. But if there ever is a reverse of that, okay, if it inverts where the nearby contract, for instance, going back to November, if this ever shows, and we probably won't see it until 2021's delivery contracts, but if the nearby contracts, like this is considered a nearby contract is the month that has all the open interest And as we get closer to October, it'll roll over to January. And the open interest will be more in January, even though that we haven't really got to November yet. There's just a rollover that takes place because these contracts expire. So if you're trading them on a long-term basis and you want to be a part of a long-term move and say you're bullish and you think it's going to go to $15 a bushel, you would have to roll out or sell your November and buy January immediately, and just call your broker up and say, hey, I want to do a rollover from this contract month to the next month. Okay, and then they'll sell you out of your nearby contract, which is November now, and buy you January or whatever the next month would be, in relationship, because all of these markets have specific delivery months. They don't trade every single month. Just like currency futures don't trade every single month. You have March, June, September, December, then back to March the following year, and that's the cycle. So each one of those contract delivery months have an expiration date. So you have to make sure that you're aware of that and be out of the market before first notice day. And I cover all that stuff in the mentorship. But nonetheless, if there ever is a relationship like we're seeing now where the dollar's been clearly going lower, we were looking for that, that means commodities are going to go higher. When you've seen me talk about this on Twitter, and I mentioned it in mentorship commentary too, that we're going into a bullish market for commodities, it's because I saw the relationship of the dollar going lower, and I taught you the relationship, the dollar going lower, major market analysis, and macro view is that commodities will go higher. Not all of these markets will go up equally. You want to find the leadership. Which ones are the relative strength leaders? So we've already got our mindset on soybeans. So now all we have to do now is watch as we go into 2021. If the dollar really starts to break down and this commodity goes to a premium where the nearby contract starts selling for more than the next month's out, then that is a commercial bull market. That's an inversion of a carrying charge market. The only time that will ever occur is when the commercial users are in such a demand to buy this stuff, they're willing to pay more right now. Whereas it's normally cheaper right now than buying it in the future. Because when you buy something in the future, the producers of that commodity or the handlers of it, like for instance livestock, like cattle prices and pork prices, and like pigs and lean hogs and such, that incurs more costs. They have to feed the animals, they have to store the grain, they have to process the grain, harvest it. All that requires expense and insurance. So the producers of it, when they create that, they use the futures market for that purpose, so they can lock in a good price. If they're willing, if the large consumers of these items, like food producers, if they know there's going to be a shortage and the fundamentals are really driving, and fundamentals absolutely drive the commodity markets, that's why it's important to understand these things, because you can go through life never touching any other market but just commodities and literally change your entire net worth. Like it can happen in 1 year, but you have to know what you're doing. And if you don't know what you're doing, you can get hurt. But if you do know what you're doing, you can do with a very small shoestring budget, like $10,000. And that might sound like a lot of money to you now, but 5 years from now, $10,000 isn't going to feel like a whole lot. But you can take $10,000 and put that in a market like this, with call options and such, and turn that into a fortune. And then that next year, do the same thing, because these types of moves happen every year. I mean, it sounds like a big deal, $5,000. Michael, you've shown $12,000 in trades just yesterday with trading Forex. Yeah, but these are opportunities that are setting up potentially where they can move 15,000. I mean, look what happened in gold. I told you gold was going to go up. It went up more than people make in a yearly salary. Think. That's what this stuff does every single year. You don't need a reoccurrence of Bitcoin going to a failure of 20,000. These types of moves that I'm talking about, this is going to be potentially the next Bitcoin. If we have the problems I'm thinking that are really laying the foundations for right now, if all these things are true, that I've hinted at and talked about, then the commodity markets are going to explode vertically in 2021. Like, I'm talking big time. I mean, soybeans really could be $20 a bushel, depending upon how bad it can get. Like, nothing says it can't go there. But if you look at historical price data going back 30, 40 years, you'll see it's moved like that before. We've had big old moves, man. And when it moves $1 a bushel, that's $5,000 per contract. So if it moves from $10 a bushel to $11 a bushel, that's $5,000 in profit or loss, depending upon how you traded it. It can move potentially $3, $4, and that's $15,000 to $20,000 per contract. And you don't need a whole lot behind something like that to change everything about what you're doing, in your life. What would $100,000 do for you if you were able to do that next year? Think about that. Like, that's crazy. Like, I didn't think I'd make that kind of money when I was a younger man. And I'm telling you, you're learning a skill set that could put that type of thing in your hands every year. Every year. And some years, like we're getting ready to see potentially some wild chaos break out. If that's true, unfortunately, as much as I don't want to see people hurt, die, lose things, lose their homes, economy crash, I don't want to see all that. I don't want to see that. But guess what? If it does happen, I can't change that. But I can find opportunity in that. So you can be on one side of the fence or the other. I don't want those things to happen, but should they happen, I'm making money with it. And I'm going to go in there with both guns blazing. Okay. I'm going to try to do something I've never done in my life, which is crazy. But, you only live once. And I'm going to try to go in there full tilt and just go cowboy up. And I'm going to go in there and try to do as much as I can and try to capture these mega moves. But if we have the dollar going down, open interest declines in environments like this. We have a big drop off in open interest. That means the commercials are short. They're not short anymore. They're covering their short. And they're only going to cover their short so if they know that the market's going to explode on the upside. And if that happens when there's a premium, that means the nearby contract, and as I was saying with this being November, this is the nearby. Say we go to January, okay? And the next month out after January, if that contract month is trading at a lower price than January's, then we have the commercial bull market. That means when we have bearishness on the dollar, that means we're going to see explosive vertical, almost limit up days and potentially limit up days in commodities like the soybean market or whatever currency, or not currency, but whatever commodity has a premium. It could occur in coffee. It could occur in orange juice. It could occur in cocoa, sugar. I'm absolutely thinking sugar might get messed around with too, because it's a main staple in food. It's used in almost everything. And, if it's used as a weapon against civilians, and I know this sounds like, crazy science fiction stuff, but look around, folks. Look around. Really take a look at what's going on. It's madness. Like, they're killing the economies over a cold. I mean, I hate to sound that way, but it's the truth. They're making more out of this than it really is. And it's only because they want to destroy the economies. They want to do that because once they do that, populations will reduce and there'll be a more control of them. And it's just no other way of saying it. It's just, that's what it is. So what greater weapon could they use than food? Because if you upset food, you're going to have people in the streets fighting against each other. They don't need to do anything. It'll just work itself out. People will start breaking into other people's homes, taking what they have. You're going to start seeing, here's what's going to happen. You're going to start seeing food delivery trucks held up, hijacked, and all those items and things are going to be taken by force. And that's going to disrupt the food supply chain. And you're not going to get it to the store because truck drivers are going to say, the heck with this, I'm not doing this anymore. And they don't care. My life isn't worth the cargo of a truck if I was driving a truck like that. If someone holds a gun to my head and says, I want this truck, have at it. Drive safe. I'm out of here. Let me get my personal things out of here and see you later. I'm not trying to go up against something like that. But that's what I'm seeing coming. I feel that's exactly what's coming. So all of that leads to a disruption in the food chain supply. And if that is true, and it might not happen, I hope I'm wrong. I absolutely believe that the potential for me to be wrong is there. And I want to be wrong. As much as I would love to be able to make that kind of money, I don't want to see those things happen to be a catalyst for it. But I know I personally, individually, can't stop something like that. And if it does happen, I'm not going to be huddled up in my home, scared and wondering what's going to happen. I'm going to be in these charts, hopefully if I have an internet connection, trying to do the best I can to build even more of a legacy if we all live around here long enough. So that's enough for your 1984 discussion and tinfoil hat. And I know you probably didn't like that if you don't like that part of my discussions. But I need you to understand what causes these types of movements in the commodity markets and what makes them go crazy. And we are moving into a time where back in the 70s, like if you look at the old charts from the 1970s, look at the grain markets back in the 70s and the 80s, where we had like big moves, like crazy big moves. That's the kind of stuff that's coming. And I'm so excited because if you look at the things that like Larry Williams shows in his 1970s book where I made $1 million trading commodities last year, that book, you should have that if you don't have it in your library. But those old charts, and he's showing you those types of price action moves, that's the kind of stuff that's coming. And it feels like Christmas. Okay? As bad as it is that causes those things to happen, I know what I'm going to do. When I first read his book, I didn't know and I didn't understand or even fully appreciate what he's showing there. But I do know now. And the commodity markets have been really quiet for a long time, and it's overdue. Think, if the stock market goes down because, I don't know, anything can happen, or it fails to go up or down, to say it just goes stagnant, but all these other things start going on, which would be a very unlikely thing, because if all these things are happening, the stock market's probably going to crash. But I'm not trying to talk on that because it's defying gravity now when it doesn't make any sense. So even though we're declining seasonally, as we should, I'm still expecting this thing to find some kind of seasonal low in the fall between October and November, and then trading up into 2021, barring any kind of madness that may hit the streets. But if all these things come to pass, I know what I'm going to do to engage with it, and you are here with me. So when we look at undervalued call options in the market, it's just loaded to go higher. It doesn't take much to go into something like that, like a couple $100 per option. And that one thing could potentially pay out a quarter or half of what you probably make in a year for each one. Like that's exciting, man. That is really, really exciting. And it's been overdue. There's going to be a huge bull market in the commodity markets. And when this market starts, it will be explosive, because it's not like everybody sitting around buying an optimal trade entry in the foreign currency market, okay? Or even institutional traders. Because when there is a short supply of a commodity like soybeans, there's only so many crops of soybeans on the planet. You can't just plant soybeans and have them next week or next month. It doesn't work that way. So there's time involved. And if you have a lack of supply of a commodity, when the commercial users need it to make their food, to run their restaurants, to produce the meals that even our military has to eat. Think, all these things have to be used. Corn, wheat, oats. These are all real things, and they can't be produced fast. They're just, they can't be done that way. So when there is a bumper crop, then obviously that means there's a whole lot of it and the price will go down. But we're not looking at bumper crop conditions. We're seeing things that are leading towards an insufficient supply of it. And people need to eat. You can have gold bars in your house and silver coins, all that stuff. That's a commodity, but you can't eat it. And I'm going to tell you something. If I had a storage of food and you came over my house and said, I'll give you this gold bar for some food, I would give you food, but not because you want to give me gold for it. Because in those situations, I think that's one of the weirdest things when they say, if it gets really bad in SHTF situations, and you can figure out what that means. When there's a condition that bad, I don't believe in the bartering system with gold bars and silver, because people are going to want to eat, and I think things like whiskey and tobacco products, they're going to be more of something that would be used for bartering if things get really, really bad, to get food or even ammunition, for firearms and stuff like that. And you're probably thinking, what the heck are you talking about, ICT? This is the stuff I think about all the time. And these are the things I've been planning for the last 15 years. Like, I want to prepare for my family to make sure I have things. I don't drink alcohol, but I'll have those things should I need to change someone else's mind about something. Or if I have some need of something that I don't have and they have it, they may be willing to trade with me. So I think like that. It may not feel normal. It may seem like lunatic fringe, but look, everybody was thinking that everyone that prepped and thought that, stockpiling food and things like that, I've always done those things for the last 15 years. I've anticipated things like this coming. But everyone thought that Noah was nuts until it started raining. He was a conspiracy nut until it started raining. So that's the analogy I like to use. You don't want to be looking at a need for something and not being able to have it because you just thought it was silly to have it or extras of it. So just think about what you use on a daily basis. And if you can afford to pick up one extra one every time you go out to the store over the coming weeks and months leading into November, it's probably a good idea to do it. Batteries, light bulbs, obviously toilet paper, just your normal staples. Salt. A lot of people don't think about salt, but when we went through all this recent rush on all the grocery stores and such, I keep several things of salt on hand, but I wanted to get more because I felt that we were going to go longer without a supply of it getting to the shelves. And we couldn't find the salt like it wasn't in any of the stores. And sugar was the same way. Canned goods. It's just, I know some of you aren't equipped with finances that would probably allow you to do very much, and it's a struggle for you to be here, to pay your payment. But if you can talk to your family members to, come up with a way of working together, to try to get whatever you can stored up, it's things that you're going to use anyway. It's not a waste. But you don't want to be thinking about having me told you multiple times that to do this and feel better knowing that you have it versus saying, well, nothing's going to happen. I appreciate the thought, ICT, but you're a crackpot. This is stick to trading. Listen, trading won't matter if you can't eat. I've had people leave the mentorship in the first half of this year because they had to do that. They had to take care of their family. I can't change that for them. So they may not have had the fortunate luck, or circumstances that you have had thus far. And you may encounter it going into the winter. And they may not be able to ever come back in and restart in January. So it's not going to be easy. But there's a silver lining in this if you look for it. And I'm trying to show you here. Even though you may not know what a soybean is, because when I first learned about commodities, I was like, what is a soybean? And to be frank with you, I don't really know. I just know that I don't sit down at the dinner table and sit down and eat soybeans, but I know I eat food that have had soybeans in it. And these are real commodities. These are real things. And they have real supply and demand factors behind them. So when there's big moves like this happening, or potentially in the making, when large commercial users go in to buy it, they're not just buying it because they want to make money. They're buying it to survive. They have to have these commodities. I mean, like Hershey, it needs cocoa. It can't operate without cocoa. You take cocoa out of the market, or it's not available, it's it. Chocolate's not happening. Not from Hershey, it ain't. Assuming that they couldn't acquire it. Back in the 80s, Larry Williams actually bought so much of the sugar when it was in a commercial bull market. He basically was selling to real users and producers of products that used large amounts of sugar. He was selling it above what he paid for it at the closing price on the futures contract. So he made a mint off of the actual profiting of it, but he took the delivery of the commodity also. Like, he took ownership of the sugar. Think about that. And then he was selling that to companies that needed it because they needed it. They absolutely needed it. It was the reverse of what we saw in the oil market this year, where the oil market was flooded with supply and they were paying people to come take their oil because they didn't have any place for it. And you can't just shut the pumps off. They got to keep pumping. So they were paying people to come get their oil versus selling it for a profit. Larry Williams, he had so much of the sugar, and all these other people couldn't get it. All these companies, they could not get it. So he was selling the actual sugar to them. And that's what we're looking at, the makings of those types of environments. I'm not saying it's going to be soybeans. It may be wheat. It may become corn later on. But I'm just saying that all of this structure here is a precursor to a potential storm coming in 2021 with food. Watch the grain markets. Watch the livestock markets. Live cattle, lean hogs, feeder cattle. Watch those markets because they've already went up a lot, but they can go up a whole lot more too. So anyway, I felt like just shooting from the hip, talking to you about what's been on my mind, and maybe it's been of no interest to you. Maybe I bored you. You probably yawned about 4 or 5 times. But we are entering uncertain times. We clearly are in uncertain times, but we're also entering in some really, from a trader's perspective, we are entering into some of the wildest opportunities that you've ever seen. You think that crypto was awesome a couple years ago. Watch what could potentially happen in these commodity markets. I'm going to show you what I meant when I said I don't need a Bitcoin, because what we're about to see, I'll smoke what Bitcoin has done. It's nothing. That market is nothing compared to what we're looking at. This is something that could potentially be global, a global shortage of food. We're not just talking about American companies that need to buy this commodity. We're talking about China. We're talking about Russia. We're talking about Venezuela, Africa, all these other big countries. They're going to be looking to buy. And if they don't have it, it's going to drive the price through to the moon and beyond, like way out there. And it's mind-boggling to think how crazy this could potentially be. But I'm not doing it with futures market contracts. I'm only going to do it with options because I don't want to get caught off. And I might be wrong. I might go in there and build up a large position, and then it could take it against me. I won't worry about that if it's options, because options are limited to what you pay for the premium. In other words, if the premium for the option to buy it, like say if I want to buy one option on soybeans, say it's July soybeans 2021 contract, and I end up buying the option for say $300 an option. So $300 plus whatever commission I have to pay, that's all I could ever lose. If the sun doesn't come up tomorrow at that time, I cannot lose more than what I paid. That's it. if I buy the futures contract, I have unlimited loss potential. Whereas I have unlimited profit potential. I have unlimited loss, and to the point of margining out. In options, you have theoretically unlimited profit potential, which, if you look at the life of the option, you have time decay. Obviously, that will have a big impact on it. But if it starts to move, and it moves a lot, I won't stay in the option. I'll exercise the option and go into the futures contract. But it needs to do certain things, and I'll teach you all that stuff. But for now, just know that even if you don't have a whole lot of money, maybe you have some things around the house that you can sell in a yard sale, a swap meet, something like that, and start building up some extra money and have it on reserve. So when we go into 2021, some of these ideas might be worth looking into. I'm not going to tell you, buy this, buy that. I'm going to say, in my wording, I'm going to say, I'm doing this, and I'm going to physically tell you, do not do what I'm doing. Paper trade it. Do you understand what I just said? There will be a time, probably, in 2021, where I'm going to say, we're going to paper trade some options, okay? And I'm going to be doing my best to go in there and push it to the limit. I don't think you should do that. But if, say, for instance, you hypothetically put down $300 and that turned into, and I'm not saying this is going to happen, so please don't misinterpret what I'm saying, but if we would have did something like that down here and say you paid $500 with commission, that's all that could have been lost. You could lose that $500, absolutely. And it is what it is, you lost it. But if you're willing to lose it and say, it's it. It's one of those things, because if you look at what you've done in the last 5 years, you've wasted $500 on things that were sillier than that. You may not feel like you did, but you did. Everyone does it. So if you just toss that in there, if you would have had $500 invested here, and maybe even less than that, and you took that to over $5,000 in potential profit, there's nothing wrong with that. That's actually good. I mean, that's a good rate of return. It's not get rich. It's not retiring. It's not changing anything in your legacy or family tree, but it's certainly better than not having it, isn't it? So it's just something to think about. I am strategizing every week, building a plan how I'm going to do this, and I'm watching. Even though we don't talk a lot about commodities, I am really hawking them because I'm looking for all the things that I teach you in the mentorship when we talk about commodities and mega moves and mega trades and such. All of that, I'm doing that every single week. So when I sit down, like on Saturday tomorrow, when I wake up and I'm relaxing, when everybody else is still sleeping, I'm going to be going through the commodity markets. I'm going to be looking at all their contract delivery months. I'm going to be looking at the commitment traders on all of them. I'm going to be looking at some of the fundamental data because while I don't generally look at it any other time, I'm really concerned about it now because we have things going on in the world that's just, it's stupid not to be looking at it. Because when you look at crop reports, that's real numbers, folks. That's not finagled. They don't manipulate that kind of stuff. They have to report that from the agricultural regulators. They are mandated. They have to report these things. So there isn't a whole lot of funny money games. And when the markets move in the commodities, they're really moving on a supply and demand factor. And I'm really trying to get dialed in so that way if these things do fall in line, I'm going to be real happy, to say it that way. And that's all I'm going to say for now. So hopefully this has been a interesting conversation. Hopefully you've learned something this teaching with the relative strength analysis and how you can find explosive price action moves. And maybe I've piqued your interest in starting to pay more attention on the commodity markets because what you're learning isn't limited to Forex. It's not limited to S&P futures indexes and crypto or bonds. It's all the markets. All of these markets operate, but there's a specific thing that happens in commodities that you need to be aware of, and we're lining up that thing right now. It's turning into all the things that Larry Williams talks about in that book. How I Made $1 Million Trading Commodities. If you can afford to do so, buy it. Get it, read it, cover to cover. Just don't pay attention to all the stuff about the full moons and things like that. I don't subscribe to all that. But everything else, absolutely golden book, and everything in that relating to what I just outlined here, it still works today. And we're looking at all the beginnings of all those beautiful environments where those explosive price action moves occur. So with that, I'm going to wish you a pleasant weekend. Relax, enjoy this weekend, rest, and I will catch up with you next week, I'm sure, by way of YouTube on Tuesday and in our midweek review on Wednesday. Until then, wish you good luck and good trading.